Assalamualaikum, my name is Afifa, matric number 1180773. So today I will present an assignment from the portfolio which we are given 100% ringgit as dummy fund to invest in 5 different shares in various industry. Therefore, the market I have choose are Tenaga Nasional Berhad, Ecoworld Develop Group, Jishan Corporation, Sandar Berhad and RHB Bank Berhad. And here is selected portfolio distribution, which each wave of stock was stated at 20%. Meanwhile, for my expectation for the return, I expect for Tenaga Nasional at 50%, Ecoworld at 24%, Jishan at 23%, Sandarbi at 25% and RHB at 30%. Next is calculation of return, variance, standard deviations, correlation, and covariance of each stock. Firstly, we need to calculate the return, where the formula are current price minus previous price, then divided by price. Okay, next, as we can see from the right Excel, which is table 1, show the average return, standard deviation, variance, and Sharpe ratio for each 5 stock. And as we can see, Tenaga Nasional Berhad got negative return and Sharpe where this might give disadvantage for investor. Similar with RHB, where the average return are 0, that might also give the advantage to an investor. So for the correlation, which is in table 2, we can see the correlation between Tenaga Nasional with Ecoworld and also Sandabi with Ecoworld are negative. If the correlation are negative, means that the external variable are moved in opposite direction. For example, if there is increase in Tenaga Nasional, it associated with the decrease in Ecoworld. Next is covariance in table 3. It shows that covariance between Jishan and RHB is negative, which means both markets are moved inversely. Okay, next is risk calculation. For the risk-free rate and risk premium are taken from market risk premium as the link given, which is I select the risk-free rate and risk premium on November 2021, while for the beta of each stock was referred from the web of investing.com. So to calculate the CPM, firstly beta we multiply by risk premium, then plus the risk-free rate. CPM is a connection between stock beta and expected return. So the higher the CPM, the better the stock. And as we can see from the table, the highest CPM was Sandarbi at 12.655. We move to the next calculation, which is expected portfolio return and beta portfolio return. In the Excel, we can see expected portfolio return are 7.954, which means it is good return in investment since it is higher than 7. Same with portfolio beta, that greater than 1, where theoretically, if the portfolio beta was less than 1, means it is less volatile than the market security. As we can see from the Excel, it shows graph of efficient frontier where this efficient frontier was set by the optimal portfolio return that offer the highest return. We can see from the graph, the highest expected return is 10.46% with standard deviation 6.54, and the lowest expected return are 6.1% with 1.01 standard deviations. Lastly is portfolio analysis, where from the total calculation Sharpe ratio showed is 3.67, Treno ratio is 3.12, and for the Jensen alpha is 9.36. In conclusion, for 1 year of holding period of 5 stock, investor can gain 23,365 ringgit 82 cent profit due to the change of stock price based on wave 20%. Meanwhile, for the profit percentage, investor can. Besides, after calculation the optimum portfolio, investor also can choose any point that can give them maximum profit and well to diversify their investment. For example, investor can choose to invest on 5 stocks as wave that have been stated in the Excel, which is at 12.76%, 25.74%, 25.25%, 30.43% and 5.83% respectively. By selecting this an optimum portfolio, investor can maximize the profit to 31,722 ringgit and 27 cents, which is greater than 20% wave for each stock, and the percentage of the profit can be maximized up to 24.1% from the capital invest for 1 year investment. So that's all from me. Thank you.